Okay, let's talk about venture capital. The high-stakes game of finding the next unicorn. But here's the thing. In the age of AI, the entire playbook is being rewritten like daily. So, how on earth are VCs supposed to adapt and find the real winners in this brand new landscape?
All right, let's kick things off with a pretty wild reality check. So VCs, they spend a ton of time on due diligence, right? We're talking over 20 hours for every single potential investment. But get this, despite all that hard work, a whopping 70% of their forecasts are just wrong. They totally miss the mark. And in a world where just one big win can make up for all the losses, that is a huge margin for error.
Which, brings us right to the heart of the matter. When everything's moving at the speed of AI, how do these investors possibly cut through all that noise? How do they find that tiny, elusive 30%? The startups that are actually gonna make it.
Okay, so to really get into that, we've got to understand the problem first. See, the AI revolution, it's not just another tech trend. No way. It's fundamentally shattering the old models VCs have used for, decades. Think about it. The old way of looking at past performance to predict the future? That's becoming, almost useless, when AI can literally create a brand new market overnight.
And just look at the speed of this change. It's insane. ChatGPT got huge in just 2 years. 2! Meanwhile, it took the mobile internet a full 10 years to get to that same point. So what does that crazy acceleration mean for VCs? It means they now have to spot and back companies growing at a speed that's just completely off the charts compared to anything they've ever seen before.
And Rocio Wu from Forbes really hits the nail on the head here. This isn't just about things moving faster. It's about a total rewrite of the venture capital playbook. All those old methods for figuring out a company's long-term potential? Yeah, they're quickly becoming a thing of the past.
Let me give you a perfect example. You know those traditional defenses software companies used to have? Investors call them moats, like being so deeply integrated into a customer's workflow that it's impossible to switch. Well, in the AI era, a brand new startup can just use an LLM to build something shockingly similar, and they can do it in a fraction of the time and for way less money. Suddenly, that whole idea of a long-term, stable market, it's a huge question mark. So, okay, if the old playbook is basically toast, what's the new one? How are VCs supposed to navigate this totally uncertain landscape? Well, they're leaning really hard on a new toolkit of core metrics. Let's dive in and look at the numbers that really matter now.
First up, we've got the big one, total addressable market, or TAM. Think of this as the absolute biggest the pie could possibly be. It's the total revenue up for grabs if a company captured 100% of the market. And for VCs, they're usually not even going to look at you unless that number is over $1 billion. It's like the first hurdle you have to clear.
But $1 billion market doesn't mean much if you can't actually reach any of it, right? And that's exactly where the serviceable addressable market, or SAM, comes into play. This is where we get more realistic. It's the slice of that giant pie that a company can actually target with what they have right now.
And then we get even more practical with the serviceable obtainable market, or SOM. This is the rubber meets the road number. It's the chunk of that market a startup can realistically expect to capture in the near future, once you factor in the competition. This is where a founder's pitch really shows if it's grounded in reality.
Let's make this super concrete with an example. Imagine a new project management tool. The global market, the TAM, is a mind-boggling $67.5 billion. Okay, huge. But let's say they're only focusing on North America for now. That's the SAM, and it's $23.6 billion. Still massive. Now, what can they realistically get? If they aim to capture just 0.5% of that market, their SOM is $118 million. See how that funnels down from a huge number to something super tangible? Pretty cool.
And you have to get these numbers right. It's absolutely non-negotiable. I love this quote from Ivalina Deniva. If your market sizing is shaky, the rest of your pitch just completely wobbles and falls apart. It's really the bedrock of any investor's confidence.
All right, so beyond the big market size numbers, VCs then zoom way into the health of the business on a customer-by-customer level. This is what we call unit economics. And really, it all comes down to one super simple question. For every single customer you bring in, are you making more money from them than it cost you to get them? The two big numbers here are lifetime value, LTV, and customer acquisition cost, or CAC. So what makes for good unit economics? Well, the magic number VCs are looking for is this, a 3-to-1 ratio. Your lifetime value should be at least 3 times your customer acquisition cost. And why 3-to-1?
Well, think about it like this. For every dollar you spend to get a customer, that first dollar you get back just pays for acquiring them. The second dollar covers all your other costs, running the business. And that third dollar, that's your actual profit. That's the fuel for growth. It's the gold standard for a healthy, sustainable business model.
But it's not just about that one ratio. VCs look at a whole dashboard of other vital signs, like how quickly do you make back the money you spent to get a customer? Ideally, that should be under 6 months. Is your net revenue retention over 100%? That's a huge green flag. It means your existing customers are actually spending more with you over time. Then, of course, they look at predictable income through monthly recurring revenue, and they check how many customers you're losing with your churn rate. All these numbers together, they paint a crystal clear picture of a company's financial health.
And listen, when Sequoia Capital, we're talking one of the biggest names in the game, says something, you listen. They stress that positive unit economics aren't just, numbers in a spreadsheet. They are the absolute fundamental building blocks of a business that can actually last.
Okay, so we've got the toolkit, we know the metrics, but how do VCs actually use all this stuff in the real world to find the winners? What's the secret sauce? Well, this is where the strategy really kicks in.
And the foundation for everything? It's still good old-fashioned, rigorous due diligence. Look, it's not the sexier part of the job, but spending those 20-plus hours just systematically tearing apart a company's numbers, their market, their team, it's absolutely crucial if you want to weed out the huge number of startups that are just destined to fail.
But here's the thing. In this crazy new AI world, VCs are realizing they just can't do it all by themselves. And what's super interesting is this huge trend toward collaboration. In 2023, almost 70% of institutional investors actually co-invested on deals. Why? Well, yeah, they're pooling their money, but what's even more important is that they're pooling their expertise and their networks.
And this quote from Walter Gomez really nails it. It's not just about sharing cash, it's about building smarter partnerships. When you share the workload of due diligence and you get all these different expert perspectives in one room, you can make way better decisions, and you can seriously lower your risk in such a volatile market.
Okay, so we've walked through the problem, the toolkit, and the new strategies. Let's tie it all together. What does all of this actually mean for you? Because whether you're a founder trying to get funded or you're an investor trying to keep up, this is the part you need to hear. All right, if you're a founder, listen up. You have to know your numbers inside and out. I mean, be obsessed with your metrics, your TAM, your LTV, your CAC, all of it. Constantly measure yourself against the rest of the industry. And above all, be transparent. Investors are really betting on you, so you build that trust with realistic, data-backed claims, not hype.
And for the investors out there, it's time to embrace collaboration. Your network is one of your most powerful tools for digging in and doing that due diligence. You got to prioritize the startups that can actually prove their business model works, the ones with rock-solid unit economics. It's not just about finding the next shiny new thing. It's about finding real, sustainable growth.
And that brings us to one last big thought to leave you with. In a time when AI is creating brand new billion-dollar markets seemingly out of nowhere, the whole idea of risk has changed. For the longest time, a VC's biggest fear was backing a company that failed. But now that a single home run can pay for everything else, maybe the biggest risk isn't making a bad investment. Maybe the biggest risk is seeing the next Uber and letting it get away.